So guys, the hidden risks controlling most of retail traders' trades. Most traders are exposed to risks, obviously. With risk comes opportunity. But in this case, they're exposed to risks that they just do not know about. So everybody typically, when they are trading directionally, so they're entering normally with a stop loss and then either a bigger risk reward or whatever it is, trend follower, mean reversion, that's still a directional type of trader. Um, they think that they're taking on just that one trade based on whatever their idea is, whatever that may be. But the truth is that you're actually taking on multiple layers of risk that most people are just not aware of. Now, this is not me painting some like, oh, mysterious, this, that, like the market's out to get you. I'm not doing that. I'm specifically saying that these risks are not as spoken about. And so the point is the reason that they're risks is because they can influence the result and therefore it can influence the trade outcome. Therefore, probably a good idea that we at least kind of consider its value. So today, exactly what I'm going to show you, what those risks are and how professionals protect against these risks whilst maximizing their own return. So they're not sacrificing huge amounts of their return just to reduce the risk. It's about how they balance this. And there's a specific framework. I'm going to show you exactly how you do that step by step in this video. And the kind of main idea, right, is that if you don't know what risks you're actually taking, then how on earth are you going to be able to control the results or control how those results come? For example, if you're a trader and it's like, I'm like, yeah, look, I'm pretty sure my strategy will work, but you're waiting until the last month of the year for that big upswing, and the rest of the year is like this, and then suddenly it's like that. That may be suited to you, but I'd imagine for most people it's not. And professionals are much more interested, again, this is a generalization, there are always exceptions, in smoother, more consistent, and better risk-adjusted returns, meaning the most return for the least amount of risk. And so by the end of this video, you will know three things. The 5 big risks with trading indices and stocks. So I'm using that as the specific example for this video. How professionals can position to protect themselves against these risks ahead of time. So this is much more sophisticated than just I use a stop loss, bro. And then finally, how to translate this to all markets. Maybe you're not interested in the stock market. Maybe you're interested in another market. And so I will show you how to translate that as well. So this is for you. Who's this video for? Who's it not for? So that you can save yourself some time so that, well, I mean, the same amount of time for me, but you know what I mean, is you trade any major market, number one. You want to know how professionals make more with less, risk-adjusted returns. And you want to understand risk management better than I use a stop loss and a 1 to 3 risk reward bro. Okay, so this is a very common thing. You'll see various kind of proponents of this basic methodology, and there's nothing actually that wrong with it. It's more just about professionalizing the process and making each unit of risk that is on the table be more efficient. That's essentially what risk adjusted returns are. It's the reason why professional hedge funds, professional money managers are so focused on risk adjusted returns. They're not doing it just for the sake of it. They're doing it for their sanity, for their investors' sanity. There's real reasons why they do this stuff. They're not just doing it because they've been, over indoctrinated with intellectual ideas at university, which I think people have a kind of misconception over. Anyway, so first of all, again, as I said, we're going to be using this with a stock market example. So let's just say that you are pure long a stock. You've looked at maybe Tesla or Nvidia or Microsoft or whatever the hell it is, and you're like, right, I think this is going to go up. I'm going to buy it. I'm going to put my stop loss 5 to 10% below price. I'm going to aim for about a 20 to 30% lift in the market price. So these are not the only risks, by the way. These are just 5 of the big categories of risks, and there are risks within each of these, or within most of these, particularly with the factor style risk and the stock specific risks. But the market risk is essentially the overall flow of the market. So in the stock market's case, it's like a lot of stocks will be affected by the overall flow and trend of the market. If the S&P 500, which if you don't know, is just a collection of the top 500 companies within the US, if that is flowing up, if we are in a bull market, then a lot of the stocks within there, the cyclical stocks, in other words, ones that tend to move with the market, they are going to be heavily affected by that. And so this is a risk because if something comes out that has a macro shock that affects the overall market or people's risk appetites and the S&P jumps down, even if your long idea of that specific stock was really, really good, because of the market risk, you could actually lose. And so this is often why traders can have good ideas, but then just get smashed out by the market. It's because they're exposed to different elements of risk that are controlling their positions beyond just the idea that they had. Hopefully that makes sense. So again, we have full exposure to that if we just long stock. No arguing with it, you have full exposure to it. Next thing is sector slash industry risk. So this is, if we take a section of the stock market just for technology stocks, that would be the sector. And so, for example, in a similar way, if I wanted to long Nvidia, but the specific technology sector had a huge hit, maybe it was due to a massive widespread supply chain issue or a commodity that is heavily used in the production of, I don't know, semiconductors or something, like because of that, the market takes a big hit, or there's a new theme that comes out, a new narrative, or whatever it is. The idea is that this is another thing that you're fully exposed to, because you may want to pick that one stock and be like, oh, I believe in the stock, it's going to be good. But there's a whole other realm of things that are influencing that stock. So factor slash style risk, there are lots of things under this hood. This is essentially the different risks that you wouldn't even consider when longing a stock. So for example, it could be the difference between growth and value stocks, momentum, quality versus not so much quality, big stock versus small stock. All of these things have influences on how money is flowing into and out of assets. And there's equivalents with pretty much every other asset class out there, whether you trade FX, whether you trade crypto, whatever. These same kind of overall principles typically do apply, but more on that as we get later on in the video. The main point that you need to keep in mind right now is that we have full exposure to this when we are just longing that stock, because at the end of the day, we are basically putting 100% of our bet with all of the risk on this one stock going up. But one stock is not just moved by whether that company is a good company or not. Like if you're an investor, if you're like Warren Buffett, a huge time horizon, you are going to have a lot more leeway for that to be okay, because you're riding out all of these market waves. But as a trader, you don't have that luxury, because timing is important. And so understanding all of the risks and the movements and the intricacies is kind of a need with this style of approach. But again, I will go into more detail as we go through. Next one is stock specific risk. So this is the type of risk that you think that you're getting into, because remember, with risk comes opportunity as well. It's not just like these are doomsday scenarios every single time. Like there could be examples where the market risk is on your side in a bull market, the sector risk is on your side in when that sector is going through a bull period or whatever it is. But risk and opportunity come hand in hand, so it's important to always assess it from a risk perspective first. So stock specific risk, these are the things, as I said, you want to be exposed to, the things you think you're buying into, whether it's a narrative, whether it's the strength of that specific company, you believe in the company, whatever it may be. This is the type of risk that you're actually wanting to be exposed to when you say, oh, I want to buy Apple stock because I think Apple's going to go up in the next couple of months. That is the type of risk slash opportunity that you are deciding to be involved in. Next one is liquidity slash execution risk. This is going to really vary depending on the size of the stock that you're trading, the overall events going on in the market. You've got gaps in stocks. So things like if you have a stop loss and prices gap below your stop loss and doesn't trigger you out, maybe that means that you get out at an extra negative 5% or an extra negative 10%. That a few times can have a massive effect on your P&L. And so it was going to change per market. Stocks, because it's more volatile, will gap more and various other factors. But the main idea here is that the way that you execute, the way that you and the markets you interact with at the times you interact with them are going to create other risks that you need to factor in as well. And so it could be one of these risks, it could be multiple of these risks combining that actually make up a decent percentage of the losses that you have if you were just going with a simple pure long stock example. So the big question, right? What are some of the ways we can begin to hedge out some of these risks? Because this is the real key, right? Why do you think hedge funds are called hedge funds? Because they are managing risk, and hedging is one of the more sophisticated ways of managing risk. Next one is sector industry risk. So here we have a partial reduction. So sector moves are partly tied to the index. So you'll have something called sector beta, which again is how sensitive actual sectors are to overall market movements. Again, if you adjust for this, this is a partial reduction. So it's not full, you're still relatively exposed, but it's a partial reduction. And one of the benefits of this overall approach is that shorting the S&P 500 can reduce the costs of this approach significantly. Next thing is we've got factor slash style risk. So again, this is a partial reduction because the index has mixed factors built into it. All those dynamics I spoke about earlier, growth versus value, high beta, low beta, big stock, small stock. When you're shorting the S&P is already a diversified, broad representation of all of those little sub-factors. And so a lot of that risk is naturally hedged out. But again, not all of it. Next one, stock specific risk, no real reduction. But if your goal is to buy a company and long it, you're not trying to hedge out every single risk. I want to make that clear. If you hedge out all risk, you've hedged out all opportunity. For example, if I if I buy and sell the same stock at the exact same position size, at the exact same level, I've hedged out 100% of my risk. Every single one of these factors has been 100% hedged out, but so has all of my opportunity besides costs. And so it's very important to understand that the goal of hedging is not to hedge out every risk. It's about understanding which risks we want to be exposed to, because that's a better way of expressing an idea. Now, of course, all of this is riding on you having a good way of generating good quality ideas. If you don't have good quality ideas, then a lot of this stuff isn't really going to matter to you, because you're not going to have anything that you're really trying to express. Like, I might just flip a coin, and let's just say whatever it lands on, I've associated with a particular stock. So I just randomly pick a stock. That's not really going to have much benefit at all from any form of hedging, because unless there's actual alpha, meaning actual reasons why it should work, why it should be an advantage, it's not going to give me anything in particular. And so this whole approach, whilst absolutely incredible and professional in terms of its scope, you need to base it off good ideas in order to do it. And of course, none of this stuff is financial advice, guys, obviously. And so next one, liquidity execution risk. So there isn't really a meaningful reduction here. An index hedge doesn't make your stock more liquid. So basically, the more liquid an asset is, the less jumpy you're going to see moves. Classic examples, if you look to a tiny company or a really brand new crypto coin or something like that, there's going to be huge gaps in the market. There's going to be, it moves erratically, and so that's more risky. And so the same thing applies here, right? When we're looking at that risk, this risk can be diminished often the more liquidity is in the market. It's not going to be perfect, but it's going to be decent. You'll find that compared to some of the other hedges we're going to go over now, shorting the S&P is probably one of the easiest in terms of this specific risk, in terms of not adding to the risk, at least, because some of them can actually add to this risk, as I'll explain in a minute. So next one is we do a sector hedge. So this one was a market hedge. This one is a sector hedge. So we long the same stock as before, and then we short the sector that stock is in. You can have crossovers where you long a stock in the tech sector and then short the overall, I don't know, consumer discretionary sector or whatever. But for the most part, this is the premise. Anyway, so here we have, for market risk, we have a strong reduction. So most of the market beta, again, the sensitivity to market movements is stripped. However, there is some residual basis. So the reason it's a lighter green here is because it's nowhere, well, it's not as strong. It's closer to this sort of reduction, but it's not as perfect a reduction of market risk. Then we have a very strong reduction in sector risk, right? Because you're long versus short within the same sector. So in other words, if I'm buying Nvidia, which is a technology company, but I'm shorting the technology sector, then I'm hedging out a lot of that sector risk. Because if a stock goes down, which, remember, a stock is driven by multiple components, if that stock goes down, that could be partly and is likely to be a decent amount due to the overall sector movements. And so if the sector is going down, the stocks within it are going down, because the sector is made up of the stocks, etc. And a few other things as well to do with positioning and capital flows and whatnot. And so because of that, stocks, we can say, are influenced by the overall sector momentum, and therefore this specific method is the strongest way so far of breaking out of that risk and reducing that specific risk. When it comes to factor style risk, we have a similar kind of situation in terms of what we had with shorting the S&P. We have partial reduction. So sector ETF dilutes extreme factor tilts. This is just a really technical sounding thing, but it's actually pretty simple. It's just basically a reduction in the risk due to the different kind of how capital is leaning, essentially. So is it leaning more towards growth? Is it leaning more towards value? Is it leaning more towards this? Is it leaning more towards that? And so it's just reducing our exposure to that as the main factor a little bit more. Next one, no real reduction in the stock specific risk, which, depending on what our goal is and how we structure a position, that's going to be probably fine. And then liquidity risk, no meaningful reduction. Because sectors are more liquid than an individual stock, but they're less liquid than the overall S&P, liquidity risk is not reduced as much as it is with the S&P, even though it's not really reduced with the S&P. What I mean to say is, if anything, adds a slight amount of risk to the table as well when looking at the sector hedge method. So again, guys, it's important to note that all of these methods are different ways of expressing an idea. If you've ever heard a professional say things like, we are trying to express our ideas and figure out how to structure our positions, one of the things they're talking about is not, oh, how can I put a stop loss on and trail my stop and understand the relationship between my break-even rate and, my percentage return or my R return or whatever. They're saying, what is my core idea? what are the things that make up that idea? And then how can I structure what I'm doing to hedge out things that aren't directly related to that idea so that I'm exposed as cleanly as possible to that core idea? That's the whole idea behind this. Next thing, we have long stock A, short stock B within the same sector. So market risk. We have a very strong reduction, if not elimination, of market risk here, assuming we've done things correctly. We've made sure that we're beta neutral, something I mentioned earlier. It's also important, this will be more relevant if both names track the market similarly. So for example, if you have NVIDIA and AMD, similar companies, right? They are going to be good representations because they're driven by very similar factors. They have similar influences from the overall market momentum. And therefore, if you pick those, you long one, you short the other, you are in probably one of the cleanest way possibles, banking on the relative outperformance of one versus the other. So if that's uncomplicated, all we're doing here is looking essentially at the relative value change. So instead of you going, oh, I'm going to long NVIDIA because I think it's going to go up, you're longing and shorting NVIDIA and long NVIDIA, short AMD, for example. And you're saying, okay, well, even if one goes down more than the other, or one goes up more than the other, I'm making my money in the difference. That makes sense, right? And that means that obviously if you just do this with really bad ideas, it's not going to do anything, as I said. But if you have really good ideas, then this is going to be something that can begin to tilt the balance in your favor. And it's also a lot psychologically easier to trade because you're not tied to just like, this trade has to work out, this trade has to work out, especially if you diversify, which is the professional approach. Then that's going to be something to keep in mind. And you know, taking this to a full professional level is, there's a lot of kind of steps to it. I will make videos on all of the kind of subcomponents of this as well for you guys. Or if you would like the kind of A to Z version, then you're more than welcome to check out the coaching program. But you know, again, if you don't do that, that's absolutely fine as well. Everyone has their own stage and their own learning process. Next one, sector industry risk. So what's this one? So very strong reduction slash near neutral, which is basically the edge. Sorry, the what's it called? The risk. Sorry, God, mind went blank there. Risk has been largely hedged out here. So if A and B are genuinely similar sector exposures, so similar to before, I keep using the word similar. If you took NVIDIA and you took another technology company that was really different from NVIDIA, the factors that drove it were different. The actual amount of sector and market risk you're going to get reduced is actually less. And it makes you slightly more directional because the whole idea of this method is it's making it more about relative value than absolute value. It's not about this stock's going to go up. It's about what's the relative difference of capital that's going to flow into one out of another. That's more of the idea. And so the more separate they are, the less pure that idea is, which can be a good thing. Again, it depends on what the idea is and how you want to structure it and what risks you're trying to be exposed to. Maybe someone wants to be a bit exposed to the overall flow of the sector because they really believe in that sector. This is the nuance that comes into a proper trader who is basically creating a portfolio, right? They are structuring their positions in a way where they are choosing what risks they want to be basically exposed to. Next one, factor style risk, moderate reduction if A and B share similar style exposures, residual if one is more growthy, more leveraged, etc. Similar points to the previous two, just applied to factor style risk. Stock specific risk. So again, you are intentionally left exposed to stock specific differences between A and B. That's the whole point of this trade, right? You're trading the spread, you're not hedging it away. I've already made that point with previous ones. So next one, liquidity, no meaningful reduction. You can diversify slightly by having two legs, meaning you have one buy, one sell, one long, one short, etc. But both legs can still gap, they can still slip, there can still be other issues. And really the difference is that this will become more pronounced of an issue the less liquid the two stocks you're trading are, or the bigger the difference between the liquidity. So for example, instead of NVIDIA and AMD, both massive companies, if I pick two tiny companies that are really illiquid, there's not much money in them and they jump around all the time, my liquidity and execution risk is going to be through the roof. If you're trading something like FX, this differs a little bit because FX markets, especially major pairs, are extremely liquid. There's so much money flowing through them, which means they're not that volatile compared to other assets in percentage terms. And so that means that the actual liquidity risk, execution risk, is much lower, right? Anyway, I know if this stuff is new to you, all of these words may sound big and confusing, but really it just drills down to this, which is that it's about constructing your ideas and presenting your ideas in the way that you're exposed to the specific thing that you're predicting. If you're predicting that a stock is going to go up, is it really the smartest thing just to buy the stock and just rely on your risk reward? Some people do that and some people do fine off that. But the more professional approach is to minimize the risk as well. Like a lot of, average retail traders will focus all on the reward, and they'll be like, oh, I've got a positive risk reward, therefore I've done my risk management. And that's a decent start. Like, I'm not shitting on that, but it's not as professional as it can be. And obviously, it all comes down to personal preference as well. Also, when you hedge this way, in general, it requires more capital. It's just a fact, because you're running two positions instead of one. You're choosing how exposed you are to one position. Ideally, you want to have like multiple, so that if one fails, another one works, which creates all sorts of issues with leverage and yada yada yada. There's a lot of reasons, especially in the stock market. Other markets it can change, but again, that's a topic for another video. So how does this apply to other markets? So market risk. Again, just to summarize, this is the risk of the market moving against you. You buy a stock and the whole market crashes due to something that you didn't look at, an economic event or a major earthquake or this or that or whatever it is. In FX, an example of this is going to be the USD strengthening or weakening, which broadly can drag your pair with it. One thing you'll notice in FX is because the US dollar is the world's reserve currency, you will find that the US dollar almost acts as if it is the market in a sense, or it's a reflection of the market. In the same way that the S&P 500, that's not all the companies in the US, but it's the top 500, which is a big enough basket that it represents the overall economy. Similarly with FX, USD is almost like the risk on, risk off thermometer with the global economy because of its reserve currency status. So when people are scared about financial security and various other things, money tends to flow into the US dollar. That's independent of how the US dollar is performing and everything else. And so this is why, just as a side note, you'll hear things like the US dollar is a safe haven currency for that exact reason. A similar thing with crypto, Bitcoin dominates. So a similar thing, right? Like if someone trades crypto, most of the liquidity is in Bitcoin. And so you'll notice that when Bitcoin has a bull run, meaning it goes up, what will tend to happen is all of the smaller crypto coins within it will then rally afterwards. And so this is a similar dynamic to the S&P 500. Bitcoin is almost just like the equivalent for crypto. It's not a perfect comparison, but for the most part. Next thing, we've got commodities. So global risk on off pushes all commodities up or down together. And then bonds, and also another one for commodities is, general supply and demand dynamics matter a lot. And then bonds, yields shift because of macro, everything then reprices as a follow-on from that. Next thing, we've got sector risk. So just to remind you, this is the part or the section of the market that you're trading, and the idea that it behaves differently from the rest, or the overall momentum of that section, or whatever it is. So in FX, that's going to be region specific themes like Eurozone or the UK or the US or China or Japanese yen or whatever it is. Crypto, layer ones. So if you don't know what layer ones are, it's just a crypto term for, I believe, like a type of coins. I'm not a crypto expert, but behave differently from DeFi, so decentralized finance or meme coins. These are all different behaviors. They're different segments of the overall crypto space, and so they're all going to have their own personalities, differences, etc. Then we've got commodities, so energy trades separately from metals and agriculture. This is kind of obvious. Like, just think about, certain metals are going to have different dynamics to, farming commodities, or different dynamics to oil or whatever. Like, they may have some correlations, but the behaviors and the personalities of them are going to be different. And so that's something to keep in mind as a form of sector risk analysis. Then we go into bonds. So we have IG. Corporates behave differently from HY or EM or treasuries, etc. Don't worry about the technicalities of this stuff. This is basically just the message of each market has different segments, and those segments have different personalities, and that's it. Asset specific risk. So with FX, we have country specific data. So this is going to be the typical like economics, like economic calendar events, inflation metrics, CPI, NFP, unemployment, various other things, GDP, ISM reports, whatever it is. Crypto, chain outages, token unlocks, cyber attacks would be some of the risks that pop to my mind, but there's probably way more than this, obviously. Commodities, inventory shocks, weather, production issues. Bonds, issuer, default risk. That just means, for example, if you buy a US government bond, then that bond is backed by the government. And if you have really low faith in that particular government, because, for example, it's got so much debt and it can't service that debt, meaning it can't pay off that debt, then that country, that government has a much higher default risk. They're going to default on that debt. That's going to be a risk to a particular bond. This is much less of an issue in the modern world, especially with really globalized and massive economies. But it's still a factor, especially with debt to GDP rising so dramatically across so many Western nations. If you're interested in that sort of stuff, which I'm sure is a minority of you, then looking into this topic from a broad perspective would be some of Ray Dalio's books are really, really good, looking at the debt cycles, really interesting stuff. But I also appreciate it's not so interesting to a lot of people as well, which I completely get. Credit downgrades, kind of a follow on from the previous in a sense. But once you've mastered this, you need to know how to actually have good trading ideas. I've hinted at this throughout this video, and that's going to be the topic of the next YouTube video, depending on when you're watching this. It may already be up, it may not be. I'll leave a link in the description box below. Or if you want to see me rank this method of trading, the kind of overall method of creating a portfolio, then I'll leave the link for that video below as well, where I compare it against the more traditional forms of trading, which you're more than welcome to check out. But if not, hope you have an amazing day. Join the free Telegram if you want to hear some fundamental ideas and how I'm breaking things down. That will be in the description box below, but I'm going to stop talking now. Hope you have an amazing rest of your day, and I'll see you soon. All the best.